these secondary markets can get hit harder on housing downturns. But since COVID, I think we've had a few things that have changed. One is that we do have migrations patterns shifting in big ways that hasn't happened in the past, and that's really driving a lot of population growth in some of these areas. The other thing that we have is still lingering from the '08 financial crisis, when we basically put the brakes on creating housing stock. And it took almost 11 years to get back to our 40-year average on housing stock. So we have a huge low supply of housing stock that still need to be built up, and it's going to take a long time to get there. And then you throw the supply chain issues on there, the labor shortage issues. Like, we're not going to catch up to where we need to be on housing anytime soon. So I think these secondary and tertiary markets are going to continue to do really well.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
I am excited. I have Chad here with me. Chad, I'm not even going to try to say your last name. Just say it for us.
Zdenek.
Zdenek. Chad Zdenek. And in 5 minutes, I am not going to remember how to pronounce that correctly. So I'm just warning you. Many of my listeners know I am dyslexic. So even a person who is diagnosed dyslexic, actually went to special ed, can rock it inside of real estate. So do not give me any excuses about why you think you can't do real estate. I probably got a story, many stories that might match your own. So if you're using a story to stop yourself from being successful, stop it. Use the story to make you successful. So, all right, I am going to share my screen here and give you a chance to see Chad's website. So Chad is with CSQ Properties. You can see he's got an actual real life website here that actually is a real live person. Oh, wait a minute. That's right. He's on a video. He must be a real life person. So I know I'm being super silly. All right, CSQ Properties acquires, repositions, and manages multifamily properties throughout the United States. It was formed by Chad Zednik. See, did I even say it right? I didn't, did I?
It ran off the rails already.
It told
Zdenek,
you.
Zdenek.
Zdenek, a registered professional engineer, licensed general contractor, and former CEO of Mobile Illuminations. He started out in construction management in the mid-1990s, working for Swinnerton Builders before moving into structural engineer working for Boeing. Then he joined Mobile Illuminations as the CEO. Congratulations. Helping to grow the company by over 2,000% in 15 years. That is a concerted effort, to say the least, Chad. Being born and raised in Los Angeles, Chad has witnessed firsthand the need and shortage of multifamily units. This was the impetus for him to get involved, utilizing his extensive background in construction and engineering to assemble deals to improve apartment housing and maximize shareholder value. Chad received his Bachelor's of Science degree in Civil Engineering from Loyola Marymount, Master's of Science degree in Structural Engineering from USC, and an MBA from UCLA. So, Chad, so glad you decided to be on the show. I appreciate it.
Yeah, this is great. It's an honor to be on the show. Thanks for having me.
It's good to have you, truly. Chad was brought to me by Bronson. So Bronson, as many of you guys know, co-facilitate my Phoebe Pasadena multifamily meeting. You and Bronson, I think, has worked on some projects together, as well as are in another network together.
Yep.
I understand correctly. And that's how Chad got known to me. And Chad, you have been nothing but incredibly gracious and of high integrity every time I've met you, talked with you, or engaged with you. And that is part of why I'm like, you've just got to be on my show. People need to know you.
I love it. Thanks so much.
So Chad, tell us a little bit about your background. So an engineer and construction, but I think I also know that maybe construction was something that you did in high school or as a younger man. So tell us how you got from there to here.
Yeah, I've been on a meandering path. Originally, I always wanted to go into construction. I did construction work in high school, and I wanted to go into construction management in college. But at the time, there wasn't a lot of universities offering that. So the next closest thing was civil engineering. And so that's what I went into, and I really enjoyed it, actually. I stayed with construction and engineering, did structural engineering design. But I think I'm kind of a more rare breed where I wound up going pretty technical as far as I worked as a structural dynamics engineer for Boeing on the space shuttle main engines, and which was like super technical, very tricky part of the space shuttle. But then I also was like worked with my hands a lot and getting my contractor's license and doing a lot of construction. So, some engineers can be a little bit out of touch, we'll say, with things.
Yeah, I'm married to an engineer who is truly an
Oh my God.
engineer and not a construction. Not that he's bad at it, but he doesn't, I don't know. He just doesn't.
Yeah. How
Yeah.
could I forget that? I forgot you were married to an engineer. But
I am a rendering engineer. Yes.
so yeah, so the pain sometimes of the way the engineering mind works, and it's kind of its own breed.
It is.
Yeah.
Go ahead.
Yeah, your husband will be watching this. He'll get a kick out of it. Be like, yeah, I know these engineers. But
he won't watch it.
All right. I mean, I focused a lot on the practical application of things. So I never got far from my construction roots.
Mhm.
And now being back in real estate has been really helpful to have that background. And also the structural engineering design, interfacing with engineers. Like I tend to do on my projects, like more value engineering than I would have thought. And by being able to get into the nitty gritty a little bit on what the engineers are planning, like a lot of times you can save a fair amount of money by saying, does this really need to be designed this way, and kind of pushing back on them a bit. And sometimes it's just easier to over design. There's less questions from the plan checker, and it's just easier, but it costs a lot more money. So depending on how much it's costing, you may want to scale back a little bit. So we end up doing that a fair amount and saving some money on the projects. But I'll tell you, I've always been an entrepreneur at heart, growing businesses. Mobile Illumination, we had probably about 75 employees when I left. And we started that just me, my brother, my sister, and one worker. So
Wow. Nice.
Yeah, we grew that a lot. But I love businesses. And what's really cool about real estate, and I didn't realize this at first, but like you're building your own business. It just happens to be around real estate. And I love that part of things. I'm part of a group called the Entrepreneurs organization. Actually, just as of 11 days ago, no longer president of my chapter, but I've been involved in that group for like 10 years. It's a group of business owners with revenues of at least $1 million a year. And to be around that entrepreneurial spirit is great. And I found that I'm able to do that with CSQ properties in real estate. So for me, it's like the best of both worlds, being the entrepreneur and in real estate. And I'm having a great time doing it. So it's been a lot of fun.
I find real estate serves the entrepreneurial heart a lot. I mean, it's like, how many people do I know who are got maybe a traditional degree, who have been in a traditional job? And oftentimes when I ask the question, the financial freedom question I like to ask in every show, the answer has something to do with freedom over time, freedom over integrity, right? Freedom over what it is that I'm going to choose to actually create in this world. Feeling like I've created something that made an impact, right? Versus being part of a larger company where I feel like I don't have control over my time. I don't have control over the impact that I'm creating. And I may or may not even have control over my senses of integrity and the way the business should flow. And so it's just real estate calls to those entrepreneurs who want to have those freedoms in this world. And that's one of the things I love about real estate. And it's true for me as well, right? Freedom over my time, freedom over my enthusiasm, freedom over my joy. Like it gives me a chance to just say, yes, I'm going to be happy and joyful, and I'm going to do the stuff that I love. And I'm going to work hard. We all work hard. It was not that we're not working hard, but we're working hard on the stuff that we really love engaging with. So, all right. So tell me about CSQ Properties and tell me about what it is that you guys are really up to.
Yeah, so CSQ Properties, it actually stands for Challenge the Status Quo. I tend to like to do things differently. I've been on a kind of a different path. And actually our tagline is freedom through passive income. So freedom, and you can see the flag. I mean, freedom's a very big and important value of mine. And it's not just financial freedom, but it's like real freedom. But I won't go into that so much. But
we can. Well, let's stay out of the political side of it. Is there's a political side, but real freedom, like freedom over time, freedom over money, freedom over one's consciousness, freedom over one's sense of purpose.
Yeah.
Those are all
Yeah, I
really
mean,
important freedoms.
Yeah, it's amazing. And if you talk to, really wealthy people, they begin to value freedom more because they can see that you can have all the money in the world, but if you don't have your freedom, if you don't have your liberty, then what good is all the money do you? So yeah, freedom's really important part of me and part of what I try to bring to investors as far as providing freedom to them through passive income. And with CSQ Properties, we do that through syndications in Long Beach, primarily Long Beach here in SoCal, and then also out of state. So I guess I'm kind of a rare operator that does syndications in California and out of California. Yeah. And there's pluses and minuses to each of those. But that's primarily what CSQ Properties does.
And really, those were all multi-units, just to sort of keep narrowing it down. So CSQ Properties, you do rehabs, ground up development, multi-units, industrial.
Yep. So it's primarily multifamily units with heavy rehabs, value add type projects. No ground up work, although we are doing a bit more in the self-storage space, but primarily is multifamily.
You said something interesting that went by that I think as we're talking about. So specifically, like, I'm in California and I'm outside of California, and those are two different vehicles. They're two different animals, I almost want to call it. When I work with investors and I work with them as a consultant, we talk about when you're an investor in a infill area like Southern California, specifically LA, that's a different investment vehicle than being able to invest outside in secondary and tertiary markets that are less infilled. That is a different animal in the way the two behave. It is also a different animal when it comes to rehabbing, because not only is it different as far as its cash flow, its structure, and who your target tenant is, but it's also different legislatively and the amount of restrictions that you're facing. So let's talk about the two and why you're so well, you can tell us why you're so comfortable moving back and forth, but let's talk about the difference between the two.
Yeah, I mean, you touched on quite a few of the differences, and they are very different.
But lay them out, right? Because I know what I'm, and lay them out for my listeners. So it's like, because I have all this stuff in the back of my head, but you actually have the experience.
Yeah. So yeah, we'll talk about Long Beach first, and I do have other investments in SoCal, but primarily my syndications are in Long Beach. I like that for a couple of reasons. One, you don't have to deal with the city of LA, which I've dealt with the city of LA on a lot of other projects, and it's not very fun. And once you get involved in any of these sort of projects, you can start to see pretty quickly why things are so expensive in LA. Just the regulation costs and the carrying costs. Like, people don't really think about carrying costs, but like, if you have to wait on the sidelines for a particular project for 6 months, 12 months, 18 months, or ground up stuff could be years, there's carrying costs associated with that. And the investors, the developers, the people need to be paid for those carrying costs, right? It's not just that they just absorb them. They have to be paid for it. So they pass those costs typically onto the tenants, which makes things very expensive here in LA. At least in Long Beach, we deal with the county of LA, not the city of LA. So that is a little bit easier. We're dealing with the city of Long Beach. When it comes to like rent control, we have statewide rent control that we have to deal with, which was recently passed, but we don't have to deal with the city of LA rent control. So that does give us a little bit more flexibility on what we need to do. And then, the big elephant in the room is the eviction moratorium, which was just extended by the county of LA. So that is a big issue. It's now extended at least until December 2023, and that's a big challenge. And for me, I've been I'm a third generation LA guy. Like, I'm born and bred, and I breathe LA. But as a landlord, it gets pretty tough to deal with some of these uncertainties, certainly from a legislative standpoint, when you're not sure what's going to be handed down from Sacramento. And when you have an eviction moratorium that's still going on into 2023, it's like, well, how can we be doing this? And it's it's a liability. And so I've got myself as well as a lot of other, excuse me, a lot of other investors that want to diversify a bit out of away from that. And so that's what we're doing on our out of state investments. But you know, the SoCal investments, we're buying a mile from the beach in SoCal. Like the equity side is really strong. The cash flow's going to be lower, but you know, real estate runs in cycles, and I like to say that real estate runs in 10-year cycles, and people have 7-year memories. You know, like it is going to go down. It is going to have issues.
That's
and
good. Right.
and if I'm buying a mile from the beach in Southern California, I'm going to do pretty well in a downturn.
Yeah.
You know, like you look at like Phoenix, which, you know, arguably the best rental market in the United States in the last several years. From 2007, it took 10 years for the median home price to come back to where it was in 2007. In Phoenix, took 10 years.
Right.
So that's a long time. If you look at some of the beachside communities, it was less than 5 to come back where it was. So, you know, those recessions, they tend to not be as deep. They tend to be shorter. And for that reason, it's good, in my opinion, to invest here. But I like to diversify out of some of those legislative areas. So moving on to out of state stuff, and you coined it really well, like secondary and tertiary markets are pretty popular out of state. And those markets are doing really well right now on yields, right? You can get really good cash flow on those. Appreciation on the commercial side is still doing really well because the cash flows are increasing. And as you know, commercial properties are based on your NOI. So they are getting appreciation in those markets. Now, before COVID, I would have told you that I would have thought there's a little bit more susceptibility on the recession side on secondary and tertiary markets. And I know you're aware of that, but just for the listeners, a lot of times these secondary markets can get hit harder on housing downturns. But since COVID, I think we've had a few things that have changed. One is that we do have migrations patterns shifting in big ways. That hasn't happened in the past, and that's really driving a lot of population growth in some of these areas. The other thing that we have is still lingering from the 2008 financial crisis, when we basically put the brakes on creating housing stock, and it took almost 11 years to get back to our 40-year average on housing stock. So we have a huge low supply of housing stock that still need to be built up, and it's going to take a long time to get there. And then you throw the supply chain issues on there, the labor shortage issues, like we're not going to catch up to where we need to be on housing anytime soon. So I think these secondary and tertiary markets are going to continue to do really well.
And so what are you finding as far as, like, if you were to suggest to somebody on how to approach flipping, and very happening in LA, who's coming in from out of state, is the permitting the biggest differential? Like, how would you prepare them for being able to manage this?
Yeah, look, I think it's on any project, it's really important to align the business plan for that project, going back to the entrepreneurial spin on things. Like every project has its own business plan that you're doing to it, right? It might not be written out, but you have a plan that you're going to do with that project.
Yeah, that's right.
And you got to make sure that the debt is tied in with that business plan. You got to make sure that investor expectations are tied in with that business plan. You got to make sure that you know the legislative landscape that's tied in with that business plan, because that all affects what's going to happen. And when there's a mismatch, I think is where you can start to run into some problems. So for instance, if you're doing, let's say a heavy rehab on an existing building, let's say a C class that you're bumping up to a B class, like you're going to want to know what level of rehab you can do that you're going to need to pull permits for versus not pull permits. And are you going to have to vacate the tenant or not? Are you going to have to pay them, you know, some number of months rent or not to move out? And if that sort of information is not in your underwriting, that's part of your business plan, you could run into problems. It could end up costing you a lot more. It could end up taking a lot more time. And now all of a sudden your pro forma is shot because it's taken you 12 months longer than you thought to get back to get to where you need to.
You know, I love that you bring that up, because those are exactly categories that I think people from out of state wouldn't even think about. The tenant's rights here, being able to relocate a tenant, what's going to cost you to relocate a tenant, both in time and in money. Like that one topic alone is distinctly different in California than it is inside of other states with the higher tenant rights we have here. You know, I remember I was trying to do a condo conversion, and we had whole line items given over to how we're going to help the tenants relocate in trying to do a condo conversion to have the units. And it was some of those lines were like 17,000 a door, 22,000 a door, you know, like that door was going to be 17, that door was going to be 22 to be able to, and this was almost almost a decade ago. Is it really almost a decade ago? Yeah, it was almost a decade ago.
Yeah.
You know, and legislation's gotten only tighter since I was trying to play in the LA market. And you're not going to see that type of restrictions, especially on the tenant level like you said, inside of Phoenix or outside of in the secondary markets or tertiary markets outside of Phoenix.
Yeah. And I'm sorry, even with that underwriting, to have those heavy line items, even with that, you have uncertainty. It's not a guarantee that that's going to be what it takes, right? Sometimes it's going to be more, sometimes it's going to be less, both on time and money. So there is a fair amount of uncertainty, I think, that comes into play on, at least on the tenant side. And then today, like, we're dealing with cost overruns and scheduling just from a supply chain management issue that, like, we never really had to deal with. And that's like a new animal that we're having to deal with today. So there's a lot going on. And I think, you know, real estate is definitely not a place to sit still and kind of just let things happen. Like, that's why I love what you do in terms of promoting education, because even with you, with all the experience you have, like, you're still learning every day. And I think real estate is a great venue where, like, you got to be learning, you got to stay on top of it because it's changing all the time.
I have to confess, I use my meeting to keep me educated. I actually do. I invite people to come talk. So, because sometimes I'll have these, what I assume my members of my meeting are like, why is she inviting this somebody who's an expert in this niche of a something or the other? Like, why? Like, I have somebody coming who's an expert in what I call investment grade life insurance and annuities, right? It's not your life insurance that you buy to make sure that when you pass away, that your wife or your husband or your children have some tax-free income. It's like, no. There are these riders that you add. You can use it for medical expenses. You can use it for loaning against. You can use it for expanding your portfolio while you're continuing to get returns, but you need to be with the right, like, there's a whole nother way of approaching life insurance and life insurance and annuities, and being able to actually integrate it as an active part of your portfolio. And I have a life insurance policy on myself as well for all of those reasons. And I still have it as my idiot-proof policy. In case I'm an idiot, which is very much likely that I will be an idiot at some later point in my life. I might make a huge mistake, because real estate, you can really make a mistake that'll slap you up the head, going, yo, you were an absolute idiot on this one, and you just lost, $500,000.
Yeah.
Right? Just straight up. You just lost $500,000. So I have a life insurance policy that I call my idiot-proof policy, so that even if I'm a complete idiot, at the end of my life, my daughter is still going to get some kind of money to be able to help support her financial future. So I have all those benefits. So I use my meeting as a form of keeping myself educated, as well as thinking about what do my members who come to my meeting need to know in today's market with today's changes. Because there are times, like right now, where there is a lot of changes happening in the market. So Chad, why don't you talk to me a little bit about your opinion about all these changes that are happening in the market right now? Because you also pay attention to that topic just as much as I do.
Yeah. I mean, it's a crazy time right now. Like, literally, like, every day, every week, things are changing. It's very, very dynamic. And, real estate tends to move fairly slowly, right? Like, things, just in general, things move slower in real estate. But things are moving pretty quick right now. And, the Fed is driving a lot of that, and inflation is driving a lot of that. And just to give you an example, like on a deal that we're doing in Tallahassee right now, we've got 152 unit building that we're buying, a Class C building, $2 million construction budget, bring it up to a Class B. And what we were doing our pro forma on back in April, and talking about interest rates and getting our loan. And it's like, you have a floating rate to start, And it's like, wow, it's like, okay, so you got a floating rate, you got to be careful. So typically you buy a cap, right? You buy a rate cap.
Yeah,
That way
that's right.
you know that you're not going to go above that. So 6 months ago, this rate cap would have cost like maybe $50,000, right?
Right.
Well,
Yep.
you buy that back at the end of April, it's $400,000.
I have to repeat the number because it floors me when you told me the story before. I'm like, for what? $400,000 for a rate cap.
A rate cap.
That is
So
outrageous.
yeah, I mean, it's nuts, right? And especially since, traditionally it would be a $50,000 purchase, just, like you mentioned earlier, insurance, like that's a form of insurance, right? We know it's not going to go
Well,
higher.
it's controlling costs. It's being able to project your trajectory, being able to protect your investors' interest because now you have control
Yep.
of a big element inside of your production budget or your rehab budget. So yeah, it's a pretty cheap insurance to be able to cover all those bases, but 400,000 ain't so cheap anymore.
Yeah, but at least it's known, right? Like, so you, like you mentioned, so you know it, you can build it into your model. And so we did that. So, but as a result of that now is you have a lot of retrades going on, right? Where like buyers are going back to the sellers during escrow and saying, hey, things are changed, and retrading, changing the purchase price. And that hasn't happened, right? Like if you retraded, prior to 2 months ago, like you were basically blacklisted as being a retrader, and that broker wouldn't go to you again, right? Whereas now today it's very common. And like in this example I'm telling you about, we retraded for a $600,000 discount that we got. So we were able to pay for the rate cap, and pay for some increased lending costs. And that was a retrade and the seller understood, like, yeah, things are changing real quickly, and the value of that building, it's dropped a bit. So anyway, so you have these things that are going on in the market right now that are making it very dynamic. And like I told you, like retrades would have been very, very rare 6 months ago, and today they're really common. That's a big trade or change. But like for me, like in myself, talking about where are we at in the economy, like I don't want to be sitting on cash either, right? Because inflation is eating that up. And for me, I'd much rather be in cash producing hard assets. And like I mentioned before, with the low supply of inventory that we have this upward pricing pressure, and then you have inflation that's increasing the rents. So overall, I think these are still really good investments, even if your cost of capital or your cost of debt is a little bit higher. With those two factors, I mean, I think these are real solid investments, and we're still moving full speed ahead on it.
Let's talk about some of those upward pricing pressures, because you have upward pricing pressures on the units themselves, and you have upward pricing pressures because of the rents. So let's talk a little bit, because one of the questions out there is, hey, if we have increasing interest rates, how can you continue to have the caps not expand on multi-units when you go to sell them again, right? So you buy it and the cap is a 4% or 5% cap. You buy it at a 5% cap because in today's market, a 5% cap is considered competitive, right? And maybe even that's a deferred maintenance building. You're going to do your rehab. Now we're 2 years later, 18 months, 2 years later. How are you managing your cap rate on your exit, your anticipated cap rate on your exit, given the current two different dynamics going head to head? We don't have enough housing, right? And we have interest rates increasing, lending rates actively increasing. So how are you projecting that, and how is that affecting your budgets and your even performances? Like,
yeah, I mean, I think that's the $1 trillion question, right? Is what's going to be happening to cap rates, because that's driving the pricing. Like for us, like on the modeling that we do, we have a cap rate escalator, like an annual escalator that's in there, right? And for us, I think we're doing like 0.1% or so per year, 0.2%, somewhere around there per year. So depending on when we sell, because we don't know exactly when we're going to sell, but we're assuming that the cap rates are going to be expanding. And it's going to be, that's like to be conservative, right? We're assuming that. What I think will actually happen, and that's like in this example, that's like on a 5 to 6 year hold period. But what I think is actually going to happen, and that's our modeling, right?
That's why I asked, what are you modeling? That's right.
Yeah, that's what we're modeling, an expansion. which is conservative, which means, we're not going to be getting as good of a price as if cap rates stay the same or if they lowered. But what I think was with the feds raising the interest rates, really what they want to do, right, is curb inflation. That's job number one. They really are tasked to get that under control. But once that's under control, and I think this is going to do it, it's going to take a little bit of time, maybe a little bit longer than they're hoping for, but I think it will do it. But their second task is that they don't want to tailspin us into a recession either, or a very deep recession.
Very deep recession.
So I think once they cool off the markets a bit, I think they're going to drop the interest rates again. And they talk about coming in for a soft landing. It's not going to be too soft for some people, but you got to, but in general, that's what they're trying to do. And I think in order to get that soft landing, I think they're going to lower rates again. And that could be maybe even within 2 years or so. So I think if you're looking at a 5 to 6 year time horizon, you're probably pretty safe. There's going to be a lot of turbulence, I think, in the next 12 to 24 months.
Mm-hmm.
But I do think that they are going to lower them. And again, I keep coming back to the fundamentals. And the fundamentals are that we don't have enough housing supply for what we need.
Right.
And people still need a place to live. Like if you believe in those two fundamentals and you believe that you're investing in this in long term, then today's the best day to get involved.
And I do believe in those fundamentals. I mean, we truly, sincerely have a housing shortage, not just because of growing US population, just babies, right? Just more babies, right? But we're also looking at a housing shortage and that we have a lack of development, a lack of growth, like you talked about since 2008, or was it 2009? Ever since Dodd-Frank, we pretty much have construction of new units be much lower, 1, 2, and also in primarily a Class A luxury, right? I mean, we're not seeing a lot of Class C units being built by at least not here in Southern California. You are investing in other states. Maybe you're seeing more Class C being built from ground up.
No, I'm not. And I think that's more of a nationwide issue. They're not building Class C just because the economics aren't there. So they're focusing more on the Class A. You do have some government programs depending on the state where they're, Section 8 housing, and they're doing opportunity zones and some other tax strategies where the government is encouraging you to do this development. But aside from any of those government incentivized programs, like a normal developer is not developing Class C units.
Yeah, I did come across a syndicator that is in Texas that is specifically taking a quote unquote normal operating building that's a Class B building, and they're taking a section of it and turning it into state supported housing, because of the tax break that they get on the property tax is so beneficial that it actually covers the decrease in rents on those percentage of units. So the building is actually more valuable because they're converting a percentage of it over into this affordable housing. But that's a more rare situation. That's actually in all the syndications I've looked at in the last year or 2 years, let's say. I've only seen it once where they really have found that the numbers make sense that way. So no, I'm not seeing a lot of ground up Class C.
I think you'll probably start to see more of it just out of necessity, right? The government's trying to figure out how to get affordable housing, how to get housing under control. And I think you probably will start to see some of that.
Okay.
My only comment I'll say is I hope we don't slip into socialism in that direction, but that's as political as I'll get. I just think we need to tread softly in those areas as we create a lot more of these government programs.
Yes, we can have those political conversations offline. I try to keep them out of my show, but you can't stay away from them completely when you're involved in real estate, because legislation and fees, just permitting fees, and the stance of the government of that particular state so affects all the way down to how quickly we get our permits, to tenants' rights, to how much it costs, how much do our permits cost, our financial bottom line. There is a political flow that goes through the fundamentals or the core elements. Whether we agree with the state's political stance or not, doesn't really matter. The fact is, if we're agreeing to build in that state, we're agreeing to build according to what their guidelines are. And that's
it's intertwined. You can't separate the two. I mean, you can avoid it and not talk about it, but either way, it's intertwined, and it is governing how we live depending on where you're at.
They do end up being intertwined. So I'm going to jump topics a little bit, and I'm going to go to what I warned you I was going to ask you. So real estate is something that can be complicated. It is something that can take a lot of focus. I have lost money in real estate in two particular stages in my life, to the point where I'm like, yeah, those are my learning curves. Like those stand out inside of me as things that are like, boy, did I learn to be humble. I learned to not be arrogant. I learned to not assume I was bright enough to work my way around something, that maybe I don't always come up with the best solution on something, I try, or maybe there isn't a good solution, that all ships rise and fall on the tide. And I'm not the creator of the tide. There's a much bigger tide that I am at effect of. And so it's very important to be capable of being a good problem solver. I asked Bruce Norris once, I said, I didn't ask him, somebody else asked him, but I remember the response: out of all the escrows you have, how many of them do you have problems on? He said, you mean every escrow? Yeah, every escrow. He said, about 19 out of 20. It's like, it wasn't even 1 out of 10. It was 19 out of 20, like just pure statistics, right?
Yeah.
So you really need to be capable of being able to face a problem and being willing to be enough of a leader to solve the problem, and not double back into I can't, right? So tell us about a problem you faced, and what'd you do with it? How'd you solve it? How did it grow you up, right? Well, tell us a little bit about it.
I've never had any problems. I'm just kidding.
I think so.
I'm like a 19 out of 20 guy. That's I'll tell you, that's what I love about engineering, and you can probably appreciate with your husband, is like, we're problem solvers, right? Like we're hardwired to solve problems.
Yes.
And sometimes if there's no problems, we create our own problems so we can solve them, but that's a different story.
Yeah, that's true too.
So no, I do feel blessed with the engineering background. Certainly I can take emotion out of things a little bit better, for better or for worse. I can take emotion out and solve some problems. So I guess I'll share with your listeners two examples of problems. One that was solved and one that wasn't solved. So like in the beginning, I'll tell you the story of my first syndication deal. And it was in Long Beach, and I was raising 1.2 million for my first deal. And that was for, I think we had like an $800K down payment and a $400K rehab budget. So 1.2 million total to raise. And that was a big bite to chew for my first deal on the raise side. Yeah. And it was tough. So I was the only GP. I signed on the loan. Oof. And I'll tell you, I was talking with what was it Bruce or Aaron that said that?
Bruce is the one who said it. Yeah.
So talking about what Bruce said on that was, there's always escrow issues. And so I was going through and trying to raise the money and juggling everything else, which was a lot. I think we had a 60-day escrow, and I didn't know if I was fully approved for the loan yet. They hadn't signed off on it. And I hadn't raised all my money yet, and escrow was closing in less than 2 weeks. And I'm like, oh my gosh, like that was really, really stressful on my first syndication deal. And so like a week before, no, it's actually less than that. It was like 3 days before escrow, right? I finally get the approval on the loan. They finally gave me the green light.
Right.
And I'm like, oh my God. And by the way, I had at that point, I think I had maybe $110,000 earnest money that was already hard. Like it was hard, like after like 8 days or something.
Yeah, right. Exactly.
So yeah, I mean, so anyways, that was going to be gone if I couldn't close for some reason. And so I got the green light on that. I'm like, okay, good. At least I'm there. And I still hadn't raised all the money yet. So this was kind of where things didn't go as I wanted. I thought it would take me a month to raise it. Here I am 2 months in, I still don't have anything raised. And so finally, when it came to close, I wound up having to put more money into the deal. I think I wound up putting like 160K into that deal.
That was close. At least it's only 160, right?
At least it was 160K. I think I was shooting for like 100. So I think my earnest money might have been 90, and I want to end up in 100, or it was 110, want to end up 100, something like that. Yeah. So I wound up, I came short. I had to do 160. Fortunately, I had it. You always got to, you always got to make sure you got more money than you need. And sure enough, I needed it. So I was able to close on that one, but it just cost me more money. The other issue, I'll tell you a second story, was a little bit more recent.
Sure.
This one was just 3 months ago. So we're recording this in July 2022. And back in February, I was refinancing a few properties, and unbeknownst to me, things were going to go sideways in the market, debt markets. And, but I had already locked in like term sheets, and I was going through the refinance process and so on and so forth. And so doing like a ton of paperwork, right? Anyone who's done a loan, PG a loan, and like with multiple entities, like it's a disaster. So this, you're not gonna believe it. For this one property, actually, you'll believe it. Maybe
I will believe it. I will believe it, but other people won't believe it. I'll believe it because I have literally walked away from refinancing conventional because it went so freaking long to just take just going back to invest the money. I'm like, no. I've got people who want to give me money. I'll just pay them a higher interest rate. And yes, I can agree with how tough that mountain can be. Go ahead, Chad.
No, you're right. This mountain for me was 42 documents is what was finally up to on my count. 42 documents I had to send them just to refinance one property. And but now we got some historical perspective here.
Okay, go ahead.
I had this loan locked in at 3.1% for a 5-year loan with 3 years interest only, right?
Okay.
A fabulous loan, even by February standards, right?
Yeah.
So now come like April, by April, it's like unicorn standards, right? It was like you'd be like at a 4.2, 4.3%, maybe 1 year IO. And I was at 3.1, 3 years IO. So it was great. And literally 2 days before the close, the bank pulls out. And they said, you know what, we're not with it. And they swear up and down it's not because interest rates went through the roof. They just said, no, we don't feel comfortable with the deal. And they pulled out, and I lost the deal. And I still haven't gotten over that. I mean, it was like heart-wrenching. And I will say, like, if we're talking about like lessons learned.
Yeah, because that's what we can take.
I lost it. I lost the deal. I felt like there's nothing else I could do. I gave them everything I had, and it didn't close. And but maybe a lessons learned is I did not tell any of my investors that I was doing that. This was all going to be gravy. It wasn't even in the pro forma to do it. Everyone would have gotten a big chunk of money back. It would have been great. But I didn't, to put the cart before the horse and tell the investors I was doing this amazing thing. I'm so excited, blah, blah, blah. I just kept it to myself. Because it was a big bonus, and it wasn't something that was going to in the business plan originally. And now I'm really glad I kept it to myself, because I would have had, a tough conversation, because now all of a sudden your expectations are up here and you don't deliver, and that's not good for anybody. So in the end, the heartache was only with me. I still feel the pain today. And that was, I don't know, a mistake, but it was something that didn't go the way I wanted. And it was a big hit.
And it may not be a mistake. I mean, that's just because my question asked, what went south in real estate doesn't necessarily mean it had anything to do with us. I was doing a early, I was closing on a multi-unit, and I had a yield spread, which I figured out later the significance of a yield spread when I went to sell the property. But even going into the property, I was like, I'm like literally like I'm signing docs for 3 days before you're supposed to close, blah, blah, blah. And they're like, oh, by the way, the bank now requires me to put in $70,000 in a bank account. So they're willing to close because it's the first 6 months worth of payments. I'm like, you're really lucky I have $70,000 sitting in a bank account that I can go, yeah, sure, I'll give you yours. And I can sign all the documents agreeing to deposit $70,000 in the next 3 days before they'll close escrow. It's not a mistake on my part. That's just something moved, and I need to be capable of responding to it. And to me, that's not even like a big story. That's a little story in real estate. But you're reminding me of like, you need to have 2 lessons you described. You need to have extra cash, because something's going to move. It often does. 19 out of 20 times something moves, right? And you set expectations conservatively with your investors, right? You didn't overpromise, and you underpromised, and was seeking to overdeliver. And that actually yes, you're super mad about it. I remember you ranting a little bit at the Phoebe meeting about how mad you were about it. You're still ranting about it. So let me ask this important question. If real estate can be an absolute pain and things move on us, why do we use real estate to break through to our financial freedom? Because that's the name of the show, Real Estate Breakthrough. We use real estate to break through to our financial freedom because we have the heart of an entrepreneur, right? It works. Why do you continue to use it? And what does financial freedom mean to you?
Yeah, I mean, look, I think, more millionaires have been made from real estate and invested in real estate than any other industry. And if you look at the advantages of leverage and tax advantages, like to me, it's like the holy grail. And I think that those two reasons are why more people have been successful financially in real estate than anything else. And it's interesting because like you hear about it, but unless you actually start living it, then you're like, wow, it's amazing. And so like you'll see it on your tax returns and it's like, wow, this really does work. Or you'll see it on your balance sheet, your personal balance sheet as your net worth grows. And you're like, it really does work. I
can be an idiot and it'll actually work.
Yeah. So, I mean, and that's what I really love about real estate. The entrepreneurial part of it is kind of like a bonus. Like I really didn't expect that.
Okay.
I expected to have the advantages and the growth, the financial growth and all that stuff. I kind of expected because people told me, but no one really told me about the entrepreneurial part of it. And to me, that's like, I love that part. And I didn't know that. So that's kind of like icing on the cake. And for those reasons, I think I'm in real, this is the last career change I make. I'm in real estate for life.
Yeah. I had to make that decision in 2009. Like, was I going to change careers?
Yeah.
All right. Because to try to straighten out what I had was going to be a pain in the beyond. Yeah. So, but I did. I stayed committed to it for all those reasons. So what does financial freedom mean to you? What will it look like when you're there?
Yeah. So I try to take a little broader look at that and look at like freedom in its entirety. And for me, like time is a big part of that, right? Financial freedom, you can talk about, living off your passive income to pay your bills. And that generally, I think, is a good definition or goal for the financial part of the freedom. Obviously, you hope to have a little bit more than just paying your bills, but that's certainly like the threshold, right? But I think the time is really important. So I've got 5 kids. I got 4 daughters and a son. And I
didn't know you had 5 kids.
Yeah.
Oh my God. I'm sorry. I apologize. I have one. My husband used to tease about us having 6. And I used to go, no, 2 or 3 if you're lucky. And we end up getting 1. So 5. Thank you for making up for my 1.57% that I'm missing that I didn't have. Thank you for having them.
No, you're welcome. I feel like I'm carrying the burden for several people, but no, I think like being able to spend time with them is pretty important. I admire like your dedication to picking up your daughter from school every day. And that was a big part of your why. And I haven't gotten there yet. And I definitely do not have freedom of my time yet. I'm certainly a lot more financially free than I am time free. And that's why I try to look at it holistically, because you really want to have, or at least me, I think it's healthy to have both. We all know plenty of really rich people that are miserable, right?
Right.
So,
right.
So I really need to focus on my freedom of time, and I'm not there yet. I'm still, building this business, and but one day I really want to get there. And I just pray that it's not too late, with my kids growing up. But I am definitely sacrificing a lot of time with them right now.
Well, I'm sure that your wife is. I assume she's not working. Is that correct?
She was until 3 kids, and then she had to stop. And she'll tell you she works harder now than she ever has her whole life.
Oh yeah, absolutely. 5 kids. Yeah, no, my sympathy deeply goes out to her. Absolutely, lady, your life is much harder than mine.
Can you imagine breastfeeding with 2 kids in diapers and having 2 teenagers? And it's crazy. It's crazy. Yeah.
And you're partially responsible for that. You know that, right? Yeah, I'm sure she reminds you on a regular basis.
Oh, I do know.
All right. So Thank you. If anybody wants to get a hold of you, they want to invest with you, they want to be able to, get advice from you, where is it the best way for people to try to get a hold of you? What works best?
Yeah, I mean, look, I think whatever works for them, with csqproperties.com or Instagram, LinkedIn, Facebook. Email is info@csqproperties.com. And we also have a YouTube channel, which hopefully maybe one day you'll grace our presence and join me on the YouTube channel.
I would love that. That'd be great.
Put up videos there. So yeah, a lot of different ways to get in touch with us.
Lovely. So info@CSQ Properties is one of the best ways to get a hold of you. And can people get a hold of you on the website as well? I think I saw that go by. They could.
Yeah, there's a contact us form on there.
All right, Chad, I'm not going to even try to say your last name. Thank you so much, Chad, for being on this show. Thank you, my listeners, for tuning in every 2 weeks now on the Real Estate Breakthrough Show. We're on iTunes, Spotify, iHeartRadio, and a couple other platforms. We're also on YouTube as well as Roku TV. And I think we're about to get approved for Apple TV as well. So keep looking for us. Yes, I'm excited. Keep looking for Real Estate Breakthrough. I will see you guys in 2 weeks.